This is my first consultation call I have with Trade Brigade. This is part 4 of my new series I'm making, and today, Trade Brigade will teach us about the concept and psychology of spike and gap rules. Spike and gap rules in day trading are certain moments you will see happen in your day trading career on a somewhat frequent basis. These are just a different type of scenario you need to be prepared for, practice on paperwork, and just know how to execute on these situations accordingly. After 2 years, I've developed my strategy that works in a way that goes in alignment with my strategy and my personality. And again, not everything is set in stone. You need to know what works for you, and you need to understand what spike and gaps days are. But you need to decide how it is you wish to proceed with that according to your strategy, your personality, and your psychology. So, with that being said, guys, let's get into the video. Don't forget to like and subscribe to Day Trading Knockouts Out. Peace out to my fellow millionaire day traders.
Cool, man. All right, let's talk about let's get into the spike rules and like gap rules as well. And I'll talk a little, they almost go hand in hand. Rules and like gap rules as well. And I'll talk a little, about new and sleek format. But yeah, cool, man. All right, let's talk about let's get into the spike rules and like gap rules as well. And I'll talk a little, they almost go hand in hand. Not entirely, but I'm going to bring up the market profile on a different screen, and then I'll drag it over, and we could talk about spike rules. Let me get that up here. Cool. All right. Cool. So spike rules are mostly about an end of day push. And the reason it's so important is because, again, from a psychological perspective, there's a big move going on, right, into the end of day here, for example, like on Thursday, that big push. And the only reason that this high was put in as a high is because the market closed. Right? There was no, it's just, the buying stopped because 4 o'clock came around and the market closed. If the market was opened until 5 o'clock, who's to say that the buyers wouldn't have continued in the upward direction? So that's the thinking of why this is important in the first place. The buying only stopped, the music only stopped because the market closed. So we have to be open to the idea that if the buyers were not done, then we should be expecting higher prices come the next session. Or, maybe if the buyers were going to be done and that's going to act as a local top, then, okay, if this is going to be a top, we need to know like kind of what that next rotation lower is going to be. And because the market profile shows us this in quite a clear picture, we have rules to, okay, that if this is going to be a top, we need to know like kind of what that next rotation lower is going to be. And because the market profile shows us this in quite a clear picture, we have rules to basically trade around this area right here. So whenever you have a late day push, in market profile terms, we look at it as M period. If we were to look at like a candlestick chart, you would throw this on a 30-minute chart, and you would look at, 30-minute, the last 30-minute bar. Where does it not overlap anything, right? Because all market profile is a 30-minute chart compressed into one little profile, right? So watch, I could do this. Let's put this on. I can just clear that. Maybe I don't want to clear that, actually. Hang on. Let me go new drawing set. Clean. Oops. This is easier to see now. Okay, so we'll put that there, and then I'll take this, and I'll go like this, split this profile. Now you can see these two things are the same. Right? See, A period is this 30-minute bar, B, so on and so forth. This is your big push here, this is your big push here. So M period just represents when we collapse this profile, undo split. It represents the last 30-minute bar that has no overlap with the prior bar.
Okay.
So if you only have a candlestick chart, go to a 30-minute chart and just look at where there's no overlap. So that would be 39.80. Boom, 39.80. This is ES futures versus SPX. That's why there's a little price difference, but the thinking is the same. So that's going to be a key level, and the high of day is obviously going to be a key level. So remembering also that the theme of this and why we think it's important in the first place is because the buying only stopped because the bell rang. Well, if we open above the spike, then we should continue to look for bullish outcomes, because obviously the buyers are going to keep buying, and we will only stop until new sellers start to step into the market. So opening above a spike is always bullish and would imply more buying activity needs to take place. It would also imply that we're opening on a gap up, right? Which, as we know, a gap up is always bullish until we fall into the prior day's range, right? We look for gap fill and reversal, because that way we get a higher high, and then we also, on the reversal, get a higher low.
Yes.
So bullish if we open above the spike. If we open inside of the spike, it is neutral, right? You're looking to treat this as like, are we getting bull flag consolidation, basically? Because think about it. If we open and the first 30-minute bar looks like this, and then the next 30-minute bar looks like this, right? We're just staying in this spike. Technically, it's like continuation of a bull flag pattern. So you will learn something when you break the spike high, and that's the preferred outcome, is breaking the spike high for continuation. But if you break the spike low, then you just rotate back down into range, and you're looking at, whatever other structural elements you have. In this particular case, I would start to target this area here, the top of these single prints.
Okay.
Right?
Okay.
And then so we covered opening above the spike, we covered opening in the spike. And then if we open below the spike, that's lookout below. What does that tell us? Well, now all of a sudden, these buyers from the last 30-minute session on the regular hours, right?
They're hurting.
Exactly. You got it.
Yeah.
Nailed it. Right? They're all underwater. Every single one of them who bought up here is wrong about the position, and the market should move lower in theory if they're going to close out on the open. All right.
Okay.
Or it's just in general more bearish pressure for the market.
Okay.
So those are the spikes. Opening above, as bullish as it gets. Number 2, looking for continuation in the direction of the spike, and opening underneath, that's your lookout below. People are not feeling too happy about this open.
Okay. Yeah.
And the same thing can happen at the lows too. I don't think we have an example at the lows recently. Oops. Oh, this thing's all over the place. Oh man. Oh boy, what happened here? Okay, here we go. Let's see. Anything at the lows? I thought I saw one. Like this is a small spike. Usually what you want to see is like 5 or more TPOs, meaning letters here. So this is a small spike, right? The next day, what did we do? We kind of opened in the spike, a period there. And then when we take out the spike high, okay, now it's, it's higher. It never moved lower. But if we were to have opened in this area, right, sellers should have continued to push prices lower. It just didn't happen. Didn't happen. And the other thing, like, not to get too far down the rabbit hole, but, support, spike as well. What happens in the pre-market? The pre-market's this darker gray area. We break that support, and where do we open? Back above the support, minor pullback to it, and then, it's off to the races from there. So again, from a psychology perspective, this particular day here was really the result of the overnight activity getting too short under the prior 2-day support and not seeing any follow through, right? So these sellers are like, oh no, like we're opening back inside of the 2-day range here.
Yeah.
That is not what we wanted. We wanted to see prices, breaking down. So we're going to close out, buying pressure, market moves higher.
Okay. Yeah. No, that makes perfect sense. And this is everything that I wanted to I know that time's pretty much running out, but we're pretty much done. But that consolidation period we have after that gap fade and everything, I would have gotten long, but I wouldn't have been able to look at it from that perspective of how sellers are hurting at that point. Like I didn't understand that concept as much as I did learning it from this hour session.
Yeah, sweet, man. That's awesome to hear. It's definitely I think that's the most powerful part of candle charts, and just looking at where price is currently trading. You get, like, I tell people this every now and then, is like, candlestick charts are not about it. They don't hold. They're not a holy grail. all they do is they tell you where people have positions, right? If we're getting consolidation here, we know that people have positions here. If we break out of that box, right, in theory, you've got some traders who are happy, you've got some traders who are sad. In the majority of the case, right, because we've already, you know, we've walked through this today, but you get the idea, right? Technical charts tell us where people are positioned and where they have to make a decision. They're not magical, you know, secrets. They're just showing us where and when people make choices, which is where we want to be to take advantage of an entry.
Okay. Yeah. That's what I've been trying to look at day trading as.
Yeah, absolutely, dude. You're you know, well along the right path here. So